Thank you, Andy, for having me. My name is Ravi. I'm the CEO of Qapita. We do two things. We do equity management for companies, that is cap table and employee stock options and all matters relating to equity. The stated mission for Qapita is to unlock the power of ownership, and that means four things: create employee equity plans, manage them, do all the financial reporting and compliance related to that, and ultimately unlock the power of ownership, which is to help monetize those that equity.
That's great. Yeah, everybody wants some skin in the game, especially in the early stage for startups to properly motivate them.
Absolutely. I mean, if you want to be, if you want, I mean, this is a quote I read somewhere. If you want people to think like employees, talk about compensation. If you want them to think like founders, talk about ownership.
Oh, I love that. That's a great quote. We're gonna have to. I'm gonna have to write that one down. So, yeah, tell us about how you got to where you're at in your career. Where did all this start, and how did you end up starting Qapita?
Yeah, I was born and raised in India, and I was an engineer by training. I wasn't a very good one, so ended up studying finance and business school, and and had an opportunity to work with one of the largest business groups in India, the Tatas. And there, as a part of the chairman's group, I started working in the chairman's office, working on mergers and acquisitions. This was way back in early 2000s. There was a lot of M&A in the telecom sector. So worked on telecom sector mergers and acquisitions across the globe. And when you're working in one of the largest business groups in a country, you're working with every bank on the street. So I ended up with working with most banks as advisors, partners in M&A transactions. Eventually, that got me to build a career in M&A, mergers and acquisitions. I was a professional in that space for a good 16, 17 years. Initially in Mumbai in India, then Hong Kong, then Singapore. Last 12 years have been based in Singapore. Along the way, two things happened. I got to work with a large number of entrepreneurs, helping them sell their businesses once they've achieved scale. I also helped later stage companies raise money, especially when bankers get involved, which is really late stage companies. And this kind of exposed me to this problem that we are solving at Qapita. Whilst most companies in another part of the world, which is the US and Europe, were already beginning to use software to manage ownership of companies. In this part of the world, India and Southeast Asia, it was all on Excel spreadsheets. There was an opportunity to digitize everything, make everything more efficient, and also build a cutting edge 2020s kind of product in this space. And with the modern tech stack, got to started building Qapita together with my co-founders. So 3 co-founders started Qapita. I'm one of them. And yeah, between the 3 of us, we bring 3 different elements of expertise that are required from a founder problem perspective, and founder problem fit perspective, I should say. And when we saw a possibility of building a scalable venture fundable investable business model in this space, we got going.
That's great. Yeah, I'm sure you guys use your own cap table management software to divvy up the equity amongst yourselves.
100%. Yes.
That's great.
I mean,
go ahead. Sorry.
Yeah, I mean, if you start a restaurant, you got to have you got to have a meal there.
Yeah, you got to have a taste for your own food, right? Yeah. So you guys are making a dent in the U.S. market too. So I've been seeing your guys' name popping up everywhere here. Actually, I'm at LA Tech Week this week, and I've seen Qapita in a few places already. So you guys are making a lot of noise out here. That's good.
That's right. I mean, whilst we started in the India and Southeast Asia market, software is a global solution, and it made sense for us to kind of let me fix the sliding here.
No worries.
Yeah, it made sense for us to first establish ourselves, build a product that customers like in one small part of the world, which was which for us was Southeast Asia and India. And once we figured that we have a product that works for customers in one part of the world, we started looking at what are the requirements in different parts of the world. We've been active in the US for the last few months, I think 6 months, I would think, and have made good progress there, and we are getting a great reception in the market. So looking forward to building this business in the US.
That's great. We're glad to be your partner. So I guess, why is cap table management so important and often overlooked by a lot of founders when they're just excited to get their product going and forget about the details of managing the company?
It's as simple as ownership. It's something as fundamental as ownership. You need to know at any point in time, and at every point in time, who owns what in a company. It's as simple as that. Without that, there's no alignment. It's a pretty fundamental thing to drive alignment in an organization, and therefore, it's not one of those things. Often, early stage startups, we do find people think this is something that can be taken care of by your legal counsel, your paralegal, CPA. This is something a founder needs to wrap his or her head around. And it's very important because it's as fundamental as ownership. Anything that can go wrong, or that has a potential to go wrong in this, can be very fundamental to how you think about the business. And therefore, it's one of those things that is really, really important when you're building a business. And especially a venture funded business, because that's where you start to think about a rapidly scalable model. And if you're building a rapidly scalable model, the way I differentiate between any company or a startup is, generally a startup is a company designed for high growth. Mm-hmm. If you're building a business that's steady from day one and won't really grow on a rapid basis or disrupt an existing status quo in the industry, then that's a different type of scaling up, a different type of business, and that requires different. But the moment you think about raising venture capital, acquiring talent at a rapid pace and disrupting the status quo, and not merely changing it a little bit. Disrupt is a powerful word. Disrupting the status quo, then you're starting to think about incentivizing the talent pool in the organization the right way, and that's where ownership comes into play.
Yeah, and forget any investor touching your company if it looks like your cap table is not organized and managed properly.
Yeah, that's right. I mean, there are two things. One is just the cap table aligned to how the business is being built, and that's actually the contents of the cap table, what exactly is going into it. That's important, and that's only clear if you're maintaining it properly and keeping all records accurately. And then there's a compliance aspect of it. Is everything captured? Is it reflecting true picture of ownership? And so on. So yeah, I mean, two different aspects to it. First, what's the actual cap table like? And second, is it organized enough?
Have a software that could organize that for you to make it easy, so you're not writing this down on a bunch of pieces of paper and forget where they went.
Absolutely. And so many times in my banking career, and this is also how we understood the problem, we've looked at cap tables that were not organized, missing grant letters that were discovered during due diligence, and then you have to fix a whole bunch of things when it's already too late.
Yep. And I guess, what other kind of key risks should founders be aware of when it comes to cap table management?
Yeah, I think first is alignment of the cap table to what the business is. Second is the compliance aspects around it. Have you communicated enough? Are people paying the right amount of taxes? Because remember, the cap table is related to ownership, and that generally interacts with three legal systems in any country or any jurisdiction. One is the company formation laws. The second is the securities laws. And third is the taxation laws, because ultimately it's a form of compensation when you give employee equity, and therefore has tax implications at some point along the way in the cycle. And so when it links to three different legal systems, you have to ensure that it's compliant with the law of the land. And law of the land is different when you have global set of employees. Today, most startups have international employee base. I think we have people across 4 different geographies today in Qapita. We have clients who have employees across 20, 40, 60 different countries at times. And so you have to ensure it's compliant in every jurisdiction as well. So it's important to be organized. And therefore, if you want to be organized, you have to use systems and software. That's the easiest way to, and you need to have a partner who's making sure you're organized, aligned, and is delivering the outcomes for you on the software.
That's great. And I'm sure you guys cover all that, right?
Yeah, we do. I mean, that's our reason for existence.
Awesome. Well, yeah, you guys are, you guys definitely have people in multiple time zones now. So I keep bumping into Qapita people. That's a good sign. I guess, what are some red flags investors look for when they're reviewing a cap table?
Yeah. When investors look, one is, I use this word alignment or non-alignment, which means if there is equity allocated to an individual or an entity that's not really pulling its weight, that's what I call non-alignment. So, and another way to describe that is disproportionate equity to an entity or an individual in the cap table that's not actually involved in driving the business forward, and that becomes kind of dead weight from an equity standpoint, and therefore not attractive to investors when they're investing. Second is the dilution aspects. At some point in time, you want the sense of ownership. You want the founders to have a sense of ownership, and therefore how much the founders own, how aligned they are to the long-term growth goals of the company becomes important. The next is, if it is not, are the equity incentives coherent and compatible with the vision that's laid out? If I want to build a very large technology business, I want to attract the best engineers into my company, I have to make sure they have the right equity incentives. Otherwise, those engineers will end up in companies that give a good share of equity for that company. So your equity compensation policy has to be aligned with what you're building or what the vision for the company is. And lastly, I think it's well known, all incentives drive all behavior. Incentives drive behavior, period. And therefore, if you haven't if you haven't created the right pool of equity for your employees, if you are not incentivizing them well, that you aren't building for the right outcomes. So all of these tend to be different aspects. I'm going from cap table to employee equity, covering both in every response that I give, because both are equally important, become important elements when investors look at, evaluate startups or their cap tables, and if there's the right ownership alignment within the company, including but not limited to, if there are multiple founders, is the equity fairly split, and fair is not the same as like equal.
Yep. Yeah, definitely. I've been in plenty of situations where you look at a cap table and you're like, who is this guy? Like, the person that you don't see involved in anything ever. And you're like, but he's on the cap table with a bunch of equity here.
Yeah, especially if there is especially if two ways people get into the cap table. You have sweat equity or founders equity, which is there from the beginning. You have some advisory equity, which is given to advisors who help you along the way, and usually that's relatively small compared to the overall ownership. And then you have employee equity pools, which have anywhere between 5 to 15%, generally in the range of 5 to 15%, depending on the stage of the company. And if there is a disproportionate equity and most invest, and then of course there's investor equity, which comes from investing into the company, and therefore they earn their equity by bringing in capital and then supporting the company to grow. But if there's equity which is not as a result of any of these, that effectively becomes dead weight. And sometimes we have seen, especially very early stage first-time founders, making some of these mistakes and thinking about their cap table carefully at an early stage.
I guess, what tips would you offer for setting up an early equity pool for employees and founders even?
Yeah, no, great question. So maybe two different parts. I'll talk about founder equity first. I think founder equity almost always is equity or common shares common equity, as you would refer it in different markets, and that's ordinary shares in some markets. That is how founders generally have their equity, and any investors investing then get preference shares, but there's a preference for investors over common shares. Now, we have seen in some, especially more recently, founders' equity actually being reverse vested back to them, which generally means like investors may say, well, we are investing in the company, we would want founders to actually earn their equity over 4 years, or ensure that founders are around for 3 to 4 years to earn their equity. So that's reverse vesting. That's usually not captured in the cap table, usually captured in the shareholder agreements and documents. So it unvests, it avoids the problem of this, deadweight equity on the cap table that we talked about in case someone were to leave the business. So that's usually, there's a founders, between the founders there's co-founders, there's a share of equity, and that's usually decided early on, and that kind of proportionately dilutes as the company grows. The second part of it is the employee equity, which is the rest of the organization now, and this keeps growing at different stages of the company. And there we have seen employee equity pools, the normal distribution. If you leave out the extremities, it's between 5% to 15% generally, and depending on the stage of the company, it tends to change. Almost always, investors, when they issue term sheets, or when the first venture capitalist comes in, into the cap table, they would want you to create a talent pool that will help the company grow, and will insist on creating an employee equity pool. Most venture capitalists today also insist on you using a software tool to manage your cap table, so it stays organized. I would think these are two key aspects in terms of both founder equity and then employee equity.
What kind of trends have you seen in terms of how you split the equity in the employee pool? So say like a founding engineer, maybe not like the co-founder of the company, or maybe like the first marketing lead or the first salesperson for the company.
Yeah, great question again. So generally, in terms of distribution of employee equity, there are three principles. You give equity to, three philosophies, I should say. You give equity to only a select group of people. You give equity to all frontline people facing customers, or building products in case of engineering or tech product companies. And third is org-wide. For example, at Qapita, we have a philosophy from the start. We are in this business. We want to evangelize it. We said every employee gets a share of the company and becomes a part owner of the company. So that's more or less philosophical. Now, how do you decide? And it goes without saying, when you actually split the pie between a large number of people, each one only gets a smaller piece of the pie.
Yep.
So it goes without saying, and therefore important for employees to also understand that this is the philosophy in the company, and therefore I should expect this. But in terms of sizing the equity for specific people, like founding engineer, a sales, a sales lead, the two different aspects. Are you compensating for what is a market? At later stages of the company, you look at market kind of remuneration for that person, and therefore you can benchmark it to, this is your cash based compensation, this is your variable compensation, and this is your equity compensation. And usually this goes into a total rewards kind of structure, and that's for later stages of companies. Early on, it's more about how big a reward do you want this to be for the risk you're taking, because people who are joining you early are taking a lot of risk. Most startups fail, and the stats prove it. And therefore, there's a risk reward equation. And is the reward going to be big enough based on my ownership for me to take this plunge? And that would be an equation for anyone who understands how equity works. And given where the maturity of the markets, especially if you're a top engineer who's already worked in high growth companies or high growth startups, you would know that this is how equity compensation works, and therefore you would be cognizant of what's the employee equity that you're being given.
Yep. And you might overcompensate. Say if you're a you have a strong engineering co-founder team, you might overcompensate for people that could do the selling or the marketing. And if you're, the business guys starting a company, you're probably overcompensate for the engineers to get, proper vetted engineers into the company and actually give them the motivation that they need.
Yeah, absolutely. For it's what's the need for the company, and as you grow, after you've hired and you really have found, you've built a good product, then you're looking for a GTM specialist, a go-to-market specialist at that stage of the company. The next engineer will be, likely less important than the GTM person. So the needs of the business and then alignment to what talent you need within the business will actually drive. It's like any other compensation discussion, but this is longer term.
Yeah, and it's definitely important to get the right person too. So for any company, right? So don't get too cheap on it. If you really need that person, like if you really need that engineer that's going to build your product, you don't have anything to sell at the end of the day if you don't have a good product. So
Exactly, and it's again, incentives drive behavior, and there's no bigger incentive than ownership.
yep. I guess, do you have any tips you could offer founders for raising money, especially in today's current environment?
Oh, you mean raising venture capital money from? Yeah, I mean, what there's the many other people who will be really well qualified to answer this question, but I'll give you my perspective on it. And we've raised a few rounds of capital. And this is also taking in from my banker days a little bit and seeing what succeeded at very early stages. It's the founder product fit and the founder problem fit that actually tends to help. Another way of saying the same thing is, what kind of team is this team best placed to build a solution for this problem, because you don't really have any other parameters. That's very early stages in terms of, and so actually being clear in your pitch of why you are the best team, or you're able to pull together best team to solve that particular problem, and that it's a large problem matter. And then you go one stage later, it's things like your product market fit. Is there a product market fit? Do consumers really want your product, and can this be a scalable? What's the total addressable market start to come into play? And at later stages, it's actually numbers, it's metrics. Once you cross the product market fit stage, it's actually a business is defined by a set of numbers, and that you're measured for as you mature as a business, and therefore it's numbers. So I always say it's both the vision is as equally important as the detail, and so your ability to actually articulate the big vision while actually knowing the nuts and bolts really becomes important. And the other way to say the same thing is the narrative and the numbers both are equally important.
That's a great way to say it, actually. So earlier stage, it's a lot higher risk. So you're betting on the on the right horse in the right race, essentially. The second step would be product market fit, proving that there is an actual business model here. Hey, this is something we could actually get behind. Maybe it's a little bit less de-risked. And then third would be, okay, we have a real business here or not. Like the metrics are going to show for itself or not, whether you could raise that Series A and beyond.
Absolutely, yes.
Great. And I guess what causes most software products to fail, in your opinion?
Okay, what causes most products to fail is bad design or poor design.
Yeah.
And what causes most software products to fail? I think software products sometimes may not focus on the outcome they want to deliver, and may focus so much more on functionality or feature. I
Yeah.
think in today's world, the customer really cares about the outcome. So essentially, you have to deliver the outcome to the customer. You can have a great product, but if it doesn't deliver outcome to even one customer, to that customer, it's a poor product. It's maybe, it designs one element of it. Service component is another element of it. I mean, there's many ways to think about this, but I think products fail because of poor design. I think software products may fail in addition to design. It can be because they're not focused enough on outcomes for the customer.
Yeah, definitely. I see a lot of people get too focused on features and their ability to build stuff, but not focusing on solving the customer problem and whether they're delivering value in the most efficient, best possible way.
True. And we like philosophy of building is, first step is, can I solve the customer's problem, and then the next step is, can I solve it in the most efficient way, and third step is, can I solve it in the most efficient way and giving a great experience to the customer.
Yep.
And if you cross all three steps, you should have a good product in general.
That's a good point. So I guess that's why products fail, but also why a lot of companies fail too. If you don't have a good product, obviously your company's going to fail. What other reasons have you seen for companies to fail, like maybe financial or anything like that?
Oh, I mean, I remember reading a study somewhere, and this was many years ago. So, don't hold me to this. Maybe a few years ago. But the biggest reason I think they've seen companies fail is poor businesses fail is poor timing. You can do everything right, but you have to be at the right time at the right place. Like the world and the market in general has to be ready for your product. So timing is of really critical importance in a business. Second is, a large market helps everyone. A rising tide raises all ships.
Yep.
I've seen venture capitalists say this time and again. And so you often see a trend in investing. Suddenly it's blockchain, suddenly it's crypto, suddenly it's metaverse, suddenly it's AI.
Yep.
And that's because that's a rising tide. And
Yeah.
so all ships rise with it. So usually your chances of failure in a business are that much that much lower, in a market that's actually in a market where the timing is right. In terms of specific instances relating to equity, I've seen non-aligned cap tables being uh, uh, you know founders not really thinking about the cap table carefully, giving it enough weightage about who owns what, how am I going to structure the cap table of this company as the company grows, not spending enough time on it, uh, leading to non-alignment between shareholders, and therefore also businesses failing. Oftentimes thinking about the direction of the business for the long term, being able to articulate first amongst the co-founders, then with the employees, and then with the broader set of stakeholders, including the investors, is really important. I've seen companies as they grow, different investors, shareholders pulling it in multiple directions. Company can, ultimately, one set of people needs to take a call and drive alignment with everyone else around that vision, that direction. And so those are some of the equity related reasons where we have seen businesses fail. At a broader level, I've answered the question. I think it's to do with, you have to be at the you have you have to be building that business at the right time. Timing is a critical parameter. Of course, there are other things like lack of talent, not seeing how competitive, significant technology changes can impact. I think today any business that's being built today has to factor in the changes coming in through AI, and this is not just this is AI with reasoning capability that's out there, and therefore that has to be incorporated into your product design. So some of those technological changes also tend to be reasons for businesses to fail.
Very interesting. Yeah, and I'm sure. Did you guys build in any AI features into your product? Maybe maybe giving recommendations in terms of equity compensation when you're setting up
Yeah.
your cap table, or
We haven't yet rolled out. We are testing recommendations and benchmarking and what's the right set of equity to be given out. But this tends to be more bespoke and not yet AI ready in terms of recommendations. That is being tested out. But features around creating the cap table from a bunch of documents. Those are already out there. So what I mean by that is, you put in a grant letter, or you describe a grant in English, and that grant gets created on the system and then ready to be issued to your employee. Or you pull in a bunch of documents that lawyers have prepared for you, and put them onto the software, and then software figures out what the parameters are, and then creates all the records on the system ready to go. These are some of the things that are already out there. The broader private market space, where cap tables are essentially private market features. Once a company goes public, it's a registrar. It's called a registrar and no longer a cap table. So in the broader private market space, there's plenty of scope for AI related innovation. There's a lot of paper. There's a lot of terms that are not clearly tracked, monitored, understood. And if you think about it, private markets are becoming very, very large, and they're as getting close to a significant share of the public markets. But all the infrastructure that's there around the public markets is not available in the private markets, which means research, custody, asset management, ownership records, transactions, trading, all of those are lacking. All of the systems are lacking in the private market. So when you expand the problem from beyond equity and cap tables to private market infrastructure, there's huge amount of innovation that can be driven with AI in the private market space.
You guys sound like you're well positioned for that. So I guess why should people pick up Qapita today? Give us a couple high level points, so the audience listening today can just head right over to NachoNacho and pick up Qapita right now.
Two things, I think, from in terms of value, and when I say value, it's like what's the service level and outcomes and the experience you're getting for the price you pay. We are one of the best, and if you look at global platforms like G2, we would be the top rated equity management software globally. We are not the largest and the biggest in this space, so we try harder. We are better when you have international employees, so when you're spread across multiple regions, and we are building with a modern tech stack, so your experience should generally be better than some of our the other products that are out there. Most important of all, we focus on outcome for the customer.
That's great to hear. Yeah, a lot of times people overpay for all the marketing and everything that they build into the product and the company, whereas there's a lot better products out there. Just they're at a better price and ultimately a better value for your company.
Yeah, that's right. Yeah, and we're competitively priced. We're not, but then what gets delivered is better, and there's a reason why we are rated well on public forums, platforms.
Awesome. Well, Ravi, it's been a great chatting with you today. I know it's getting a little late out there in Singapore, and I really appreciate you making the time today. And we're excited about the partnership with Qapita. We look forward to getting you guys some visibility in our marketplace and growing our companies together.
Thank you, Andy. Thanks for having me. I was quite excited about having this conversation at a time that actually makes sense for our customers based and prospects based in the US. So I'm really glad you picked this time and looking forward to building a great partnership with NachoNacho.
This guy means business, everyone. It's 11 o'clock over there, and he took this webinar for us to educate us on cap table management. So, Ravi, once again, really appreciate you calling in today.